We've had a morning of talking about mutual recognition. It's clearly the hot topic. We've heard that it's almost there, but not quite there yet. So let me ask you this. From your standpoint, is there any difference between what we saw 10 or 15 years ago with the master feeder concept, when funds had to set up a master feeder structure, and what we're talking about now between Hong Kong registered funds, which will be made available in China and vice versa? Why should Chinese investors not have their own mainland Chinese funds, which can eventually, with the necessary experience and expertise, develop a global capability just like we have in the US and in the UK and in Australia and in all of these other marketplaces?
Yeah, that's a very good question. I think you have to go back to the rationale behind mutual recognition. I think the main driver is renminbi internationalization,
right?
Because we now have RQF allowing offshore renminbi being invested back into China. I think for renminbi internationalization to be successful, you need to have a very healthy two-way flow of renminbi. And mutual recognition is a way of allowing domestic saving to be invested offshore in renminbi. And you're right, China could take time to develop our own capability because we already have a QDII.
Right.
But with the mutual recognition, I think this is a very good way of opening up the capital account in a controlled manner. Because there will be quota given to these funds, and then domestic fund manager will have an opportunity to export the expertise in overseas market, because China now is becoming very important in the investment world.
Of course.
Equity index providers are now including A shares into their index, and I said it a couple of years ago that sooner or later renminbi fixed income will become part of a global bond index. Sure. And already, we have a partnership with FTSE.
Yep.
We have offshore renminbi fixed income. So all these is part of the renminbi internationalization policy.
So you're almost suggesting that it's as much a policy tool as part of a broader financial strategy than just creating an opportunity for asset management companies in Hong Kong and in the mainland? From my perspective, yes, but also I need to explain from my angle why Hong Kong is so important in this scheme, because you recall we had a mini bond saga in Asia. Yes.
At the time, most of the investors, if not all, were Asian-based in Hong Kong, Singapore, but the fund was administrated offshore.
Yes.
So the distributors didn't have asset ownership.
Right.
As a result, the liquidation process was very painful. And I think regulators have learned a very expensive lesson. Mm-hmm. And also, if you look at renminbi now still being a controlled, not a freely convertible currency. So if that's the case, then asset ownership is very important. Okay. And with funds domiciled in Hong Kong, they will be regulated by SFC, and SFC has a very close working relationship with CSRC. So in a way, this partnership would give comfort to the regulators.
No, that's a good point.
Both, yeah.
One final question. We have three sets of asset managers. We've got Hong Kong-based global or international fund managers. We have mainland Chinese domestic, well actually four, mainland Chinese domestic managers, joint ventures, and then Chinese fund managers who are operating in Hong Kong. So four managers. In your estimation, over the next 12, 24 months, which group is likely to benefit most of all from whatever we might eventually see by way of the mutual recognition legislation when it does indeed come through, which from all accounts can be any time now?
Wow, it's a tough question. Because there are a lot of challenges, but there are, I think there will also be a lot of opportunities.
Sure.
I'll try to look at it from my own perspective, how I see things. Because right now there are already a lot of challenges for mainland fund managers, also JVs in Hong Kong, because the product range that they offer is quite similar.
Very limited.
Yes. And so whether and therefore mutual recognition actually might give them an opportunity to export their domestic capability. So they may start off as an offshore distribution office and build up their global capabilities, either through organic growth or partnership with foreign players. Regarding the international firms, I think a lot they're in a very good position because some of them are global brands and already are quite well known through their JVs in mainland China. So they'll definitely benefit from that.
Let me ask you one quick question there on that. Do you not see a competitive threat between the joint ventures of foreign companies in the mainland and the
Very
Hong Kong
good question.
based? And
already. This is the question that we're asking now, because the international firms can apply for RQ fee themselves, and the JVs now they also have their own RQ fee. So how are they going to differentiate their product?
Absolutely.
And I think this is really management issues that they have to handle.
Right. So everything to play for.
Yes.
Thank you very much, King.
Pleasure.
Thanks a lot.